Many traders struggle not because they lack access to technical indicators, but because they use those indicators without considering the broader market environment, enter trades without confirmation, and assume that a single signal can reliably predict the next price movement. One of the most common mistakes is using indicators alone to make trading decisions. Indicators such as moving averages, RSI, MACD, Bollinger Bands, and stochastic oscillators can provide useful information about momentum, trend direction, volatility, and potential overbought or oversold conditions, but none of them should be treated as a guaranteed buy or sell signal. Most indicators are derived from historical price data, which means they can react after a market movement has already started. For example, a moving average crossover may suggest a bullish trend, but if the market is already near a strong resistance level, entering immediately could expose the trader to a reversal. Similarly, an oversold RSI reading does not automatically mean that price must rise because an asset can remain oversold during a strong downtrend. Another major mistake is ignoring market conditions. The same indicator can behave differently in trending, ranging, highly volatile, or low-volume markets. A strategy that performs well during a strong trend may generate numerous false signals when price moves sideways. Before taking a trade, traders should determine whether the market is bullish, bearish, or consolidating, and then consider whether their strategy is appropriate for those conditions. Support and resistance levels, overall price structure, volatility, trading volume, and higher time frame direction can provide valuable context. Entering without confirmation is another important problem. Seeing a candlestick pattern or indicator signal and immediately opening a position can lead to unnecessary losses because the initial signal may fail. Confirmation means waiting for additional evidence that supports the expected direction. For example, if an indicator suggests a potential bullish reversal near support, a trader may wait for a bullish candlestick pattern, a break of a nearby resistance level, or a clear change in market structure before entering. Confirmation does not eliminate risk, but can help reduce impulsive decisions and filter out some weaker setups. Traders should also avoid combining numerous indicators simply to create the appearance of stronger analysis. Using 5 indicators that provide similar information does not necessarily make a setup more reliable. Instead, traders should focus on a few complementary tools and understand what each one contributes to the decision-making process. A more disciplined approach involves starting with market structure and broader conditions, identifying important support and resistance areas, applying a suitable indicator for additional analysis, waiting for confirmation, and then defining the entry, stop loss, and target before executing the trade. This process encourages traders to focus on probability rather than certainty. Ultimately, successful technical analysis is not about finding an indicator that predicts every market movement. It is about understanding the limitations of indicators, adapting strategies to current market conditions, and requiring sufficient confirmation before risking capital. Traders who avoid relying on indicators alone, pay attention to market context, and wait for confirmation can develop a more structured and disciplined approach to trading while reducing the impact of emotional and impulsive decisions.